Very good evening and warm welcome to our dear investors. I'm Ghazal Jain, Associate Fund Manager, Alternative Investments, and I will be taking you through today's exclusive webinar, which will also be the last one for 2020. Could equities be a game changer in 2021? We have with us today Mr. Ivy Subramaniam, Director, Quantum AMC, and Mr. Saurabh Gupta, Fund Manager, Equity. Well, 2020 has been an eventful year to say the least. Lakhs of lives and livelihoods were lost to COVID-19 and the unprecedented policy action of national lockdowns that followed. The health crisis quickly snowballed into an economic one, and the global economy plunged into a recession. Central banks announced to do whatever it takes monetary policies to cushion the economic damage, and governments drove up their debts and deficits, doling out funds to fuel the economy. Real interest rates plummeted, and stock markets dramatically lost about a quarter of their value, only to end the year at all-time highs. Now, finally, it's curtains down on 2020, and everyone seems to be looking forward to 2021, especially as vaccines are rolled out with promises of defeating the virus and returning humanity to normalcy. What will this mean for equity markets? What does 2021 have in store for equity investors, and how can they make the most of it? That's what Subbu and Saurabh will be talking about today. We have dedicated time post the presentation for taking your questions, so do send across your questions for Subbu and Saurabh using the chat option. So without further ado, I will now hand it over to Subbu.
Thank you, Ghazal. Welcome everyone to this webinar today evening. I guess the last one for this year. Saurabh, who is the fund manager for the long-term value equity fund, and myself will take you through a few slides on this short presentation, covering our views on the macroeconomy, on the markets, and what possibilities do we see in 2021. So 2020 was definitely a very interesting year. It was a stressful year, an anxiety-filled year. Many things changed in our lives, whether it was the economy, whether it was our way of working, the way we travel, the way we eat out, everything changed dramatically. And so did financial assets, as you can see over here, how the equity index did for the developed market, the emerging markets, as well as the BSE Sensex. From the start of the year in 2020, when initially we heard about COVID, things were pretty much still under control. And then by March, I think there was a severe reaction and it collapsed. That's why we said it is elevator down. Then, of course, there was policy responses from the government, from central banks, and the markets gradually started to recover. And today it's almost at an all-time high. These indexes, it includes the developed market index, the emerging market index, as well as BSE Sensex. BSE Sensex actually fell the sharpest of the three, and then recovered the sharpest. But having said that, it still lags the emerging markets and the developed market index, which fell less, but which also grew more. But because it fell less on a year-to-date basis, it is still showing better returns than what India did. So what is in store for 2021? So we have identified the four major factors. The key one is, of course, COVID, whether you call it the first wave, continuation of the first wave, or you call it a second wave, or the vaccination and the immunization. COVID is going to be central even in 2021, depending on which way things shape up. Second important factor is what we have seen in the economy. It's recovering quite well. It's recovering rapidly. But there are still many segments of the economy which hasn't yet picked up. For instance, retail malls, entertainment, hotels, tourism. Many of these will require a lot more confidence among the populace, and that will probably come only when the vaccination is available on a mass scale. The third important factor is the continuation of foreign flows. This could be a very, very important event in 2021 and Saurabh will also speak a little more about it, because this flow can keep the interest rates lower and drive the economy at a much more rapid pace. So to some extent, we would say if this were to happen, if the interest rates were to remain low because of the solid flows, both in equity and bigger flows in the bond markets from the foreigners, then the lower interest rates will spur consumption, and that could be a game changer for 2021. Last but not the least, valuations among different sectors and the way earnings would pan out, that also will drive how 2021, which sectors will do well and which sectors will lag. Yeah, so there are four key points which needs to be understood. So is COVID-19 still an important factor? As I said, yes, it's still a very important factor. And as you can see over the next few slides, um, if you look at India currently, the number of cases has definitely been falling despite the increase in mobility. So we had the lockdown has ended, the economy has been opened up, mobility has definitely increased, but despite that, there seems to be a fall in the COVID cases in India. This is very different from the experience in the Western countries. If you look at the top portion, many of the Western countries and many even Latin American countries, the cases have actually increased. One with lower mobility, the other with rising mobility. Now there are questions on whether the data which we have in India does it adequately capture the COVID, or does it give out the information properly? Those are questions which still remain. But at this point, based on whatever is available, it looks like the COVID cases are falling based on the data. Having said that, if you speak to people across cities, I think many cities, smaller towns, um, the COVID still seems to be there, and not only seems to be there, it is still spreading. But what appears very clear is people seem to have lost the fear which they had at the start of the pandemic. So today people are saying, okay, if COVID comes, I will be under quarantine, I will take the medicines, and I will be okay. So some sort of, that fear psychosis which was there at the start, that has reduced. So therefore, people are feeling more confident to move around, and the data suggests that the COVID is under control. But things can go out of control as well. You will see that across many countries they had what they call a second wave, particularly in developed markets, UK, Germany, United States. The second wave again spiked and the number of cases due to COVID increased. So whichever way you look at it, whether you call it the first wave and the continuation of that, or there is a second wave, it will have an impact. And now, of course, in UK you have this a variant of COVID which has come about, and there are still investigations being done about the severity of the new virus. So we need to wait and see what that data will tell us. So my key point over here is COVID is still going to play a very important role. How we manage it will also play a very important role in our lives in 2021 as well. At the start of 2020, when COVID came in and the pharmaceutical companies started their experiments in finding out a vaccine, vaccine definitely looked very, very far. At that point in time, I think around March, April of 2020 of this year, we were expecting probably by the end of 2021 you will have the vaccines in place. But that is not the case. I think many pharmaceutical companies are already out with their products, and that's the good news. With vaccine being available, looks like we can control the pandemic to some extent. But there are operational challenges. For instance, in India, how do you vaccinate around 1.3 billion people? So based on the assumption that you require two dosages per person, in India it will take around 92 months for everyone to be vaccinated. That's a long time, and that can still therefore cause difficulty for India and Indian economy. At this point in time, based on what the government has announced, it looks like they plan to vaccinate around 30% of the population by end of 2021. The priority, of course, will be given to people from the medical field, people from army, police, and people who are above 50. And then it will be done for the others. So it's very important that this is executed very well. There are storage issues. There are, the kind of storage which you need to store the vaccine. Those are issues which are being addressed, and hopefully in 2021 at least it will start. The vaccination would start. So given this scenario, what does it do to the macro economy? So let's take a look at the macro economy. So prior to the COVID, India was already on a weak wicket, I would say. So the growth rates were low, and as you can see over here, whether you look at it from 2016 onwards, we had a variety of issues, whether you call it the GST, whether you call demonetization, whether it was the ILFS credit crisis, the real estate problem, all of that had slowed down the economy. And on top of that, we had COVID and the lockdown. So you suddenly saw the economic activity completely collapsing, and therefore the first quarter of this year, we had the economy declining by close to 24%. Since then, the lockdown ended and things have rebounded, and they have rebounded quite well and quite sharp in certain areas. Question still remains whether that kind of rebound will sustain. But the good news is it has rebounded quite well. The festival season also helped. India, we have so many different kind of festivals. So as companies restock their inventory, that also helped in ensuring that the GDP rebound is seen from the second quarter onwards. But net, we still need to go to the positive territory. So for FY21, it looks like it will still be negative. I think at the start or somewhere in between, the estimation was that the GDP will decline by around 10%, but now it seems to be settling closer to around 7.5. And positive growth will come in only in FY22. So you look at different parameters on a month-on-month basis since April, it has been positive. So whether you look at the purchase managers index, you look at electricity consumption, you look at freight traffic, you look at mobility, many things have improved compared to where it was in April and May, particularly in September, October, November. If you look at the data compared to where it was in April and May, things have improved, and looks like it will continue to improve from here. As I said, certain segment of the economy are still weak, and that will require probably the vaccine to come and confidence to be improved before even those sectors will start to do well. So, like in other crises which we had in the past in India, we think even after the COVID is controlled, the Indian economy will bounce back, and the consumption will bounce back. And the consumption, as I said, will bounce back as we have shared with this slide with you earlier. Our penetration levels across products are still so low that as long as we have jobs, as long as the economy continues to move at a certain momentum, the consumption will come back. And over here also, we think after the COVID, consumption will come back, whether you take two-wheelers, four-wheelers, cell phone, cement, home loans, all of which will, we think, could drive the economy going forward. So across board, you can look at the data, whether you look at the two-wheeler sales of around 24 million, this year it will be low, but by next year when things improve, that data should definitely look much better. And where you look at passenger vehicles, you look at cement consumption, I think all of them will do well. Home loans outstanding, particularly given the improvement in residential buying in the last couple of months, that also should do well going forward. So one of the reasons why we feel the consumption could come, apart from the fact that the penetration levels are low, the other big factor would be the low interest rates, and that is definitely helping. It seems to be helping right now, even in real estates. You look at different cities, even in places like Bombay and Bangalore, there seems to be some sort of revival in the real estate, particularly the premium products. There is definitely a movement. Sales have improved. The number of square feet sold today is better than what was anticipated a few months back. And part of the reason could be the low interest rates, apart from the fact that some governments have announced, some benefits from stamp duty, from GST. But definitely the low interest rates is helping today to revive the demand. Here we have given you some figures for those who have borrowed, let's say, a home loan or taken a car loan. between the interest rates which was available a year back and the interest rates currently, there is definitely some amount of saving. And as I said at the start, if the flow of money into India, particularly in the bond market, remains high, then most likely interest rates may remain low, and that can help in the consumption, including housing. And housing, as you know, has a multiplier effect. The moment you buy a house, you start to furnish it. You look at a TV, a fridge, many other things. So the first move in housing is good, as it will set the pace for other goods to be bought and sold within the so while we think the low interest rates will definitely benefit, but at this point in time, we are still cautious because we don't know whether this will happen. Currently, our thought is that Indian yields are attractive compared to the yields which are there in the Western markets. Therefore, the flow of money should come into India. Uh, but since we don't have a solid evidence right now that that will happen, we are still being cautious on our assumption on GDP growth. For the next 2 years, we are assuming 5.5% GDP growth. And after FY25, we think India will go back to the 6.5% GDP growth. Again, this is a slide which we had shared with you earlier. India over the last 30 years has grown at an average of around 6.2, and that looks doable. And if interest rates remain low, then definitely it is doable, and probably the pace will pick up even faster than what we anticipated. So we have to keep a keen watch on how interest rates will play out, and Saurabh will speak a little more on that. So these are some of my thoughts on what's happening in the economy, how we see the economy shaping up, and what are the different things which can happen in 2021 which can influence the stock markets. Saurabh, if you can take us through the what do you call the valuations, the P ratios, and some more data on the flows, then we can have the question answer sessions. Thank you.
Yeah, thank you, Subbu. Good evening, everyone. Thank you, Subbu, for taking us through the COVID-related issues and the macro part. I'll just take it from here, and rest of the two key points that you highlighted earlier, I'll just talk about those two. Yeah, so what Subbu explained, so we have seen a good recovery in the equity markets and since March fall, and the first slide which showcased that there has been a steady improvement. So the economic recovery that Subbu talked about partially explains that kind of move in the equity markets, where first there was an earning cut, but things stabilized quickly. Everybody is seeing an economic recovery, but that only partly explains why markets moved so quickly. A large part of the explanation of equity market movements have been driven by flows. So if you look at flows, how it shaped up this year, March was a big outflow in Indian equities, close to $8 billion of outflows. And then from post-April, FIs again found it attractive to invest into India because of valuations, because of relative higher growth, and flows started to come in. And November is a case in point where we saw a $9.6 billion of inflow. So if in the November month itself, the index was up closer to 12%, the BSE Sensex. And a 12% return is good for even on an annual basis. So this happened purely on a 1 month basis. What drove it is a $9.6 billion of inflows that FIs put in that one very month. And if you compare to annual numbers of last 5 years, 9.6 stand out. It's actually highest inflows in 4 out of 5 years. November month's flows are higher than 4 of the last 5 years. So this is kind of staggering number. And that puts us into thinking whether this could be a big game changer from a macroeconomics perspective, because these kind of flows, whether into equities or into debt, government bond and private bonds, can suppress domestic interest rates for a longer period of time, and then make capex easier, consumption easier in a country which is inherently aspirational, and everybody wants to afford a lot of things. So clearly that $9.6 billion, and till date the flows in India is closer to $15 billion despite having such a dip year. So that has driven markets to a certain extent. On the domestic flows side, we have seen outflows. Outflows continued. I think there was profit booking, and the mutual funds faced redemptions, and they sold into equity markets, citing valuation concerns as well. So that's how the flows into equity happen. Yeah, so briefly touched upon how this inflows could change things and how relatively lower interest rates or interest rate spread between the developed markets and Indian markets could bring in a lot of flows into India. So we just took a few slides and we're just trying to explain, can this sustain and what has exactly has happened. So if you look at the first chart, which is on your left, and I've marked it with a round red circle. That is the Fed balance sheet expansion. Now, Fed is the central bank for US, and whenever there is a crisis, what they start to do is they expand their balance sheet and buy a lot of bonds, debts, not only government but also corporate bonds, and infuse a lot of currency or money into the markets. And when there's so much supply of money, the yields start to suppress. So US 10-year, which is kind of risk free for US and more so for the world also, because it's the reserve currency. 1.5% was the yield at the start of the year, and now it's down to 0.8%. So anybody who is borrowing to or lending to, for that matter, to the US government will get only 0.88% every year for the next 10 years. So that is the suppression of the rate that has happened in US. Whereas if you compare India, in India, if you lend to the government, which is kind of risk-free rate in India for 10 years, it is still closer to 5.8 to 5.9%. So there is a large spread, and even if you adjust for currency vagaries and you hedge everything, any US investor would love to come to India and put that money purely from a spread perspective as of now. So that has been a driver of flows into India. That's the first part. And that's not the story only in US, across the developed markets. Now, there are different reports which suggest that 30 or $35 trillion of debt in the developed markets is already turned negative yield. So if you lend money, 100 rupees, you will get 99.5. You will not earn any interest over there. In India, still you have a nominal interest rate which is much higher, and you could generate positive returns. So what happens when the cost of money goes down is explained in the next chart in the same slide. What happens is your expectation of returns start to come down. So because you are start of the year, you were getting a risk-free return of 1.5% in US, your expectation of returns might be 3-4% from equities. Now, when the threshold goes down to 0.8%, your expectation from equity will also come down. And for a marginal increase in return, the money will flock to emerging markets, to India and other places. That happens, and that's purely from an investment perspective. Even from the perspective of businesses, when interest rates fall, what happens is a lot of projects become viable. So a lot of infra projects which were not viable at 8-9% interest rate, if the interest rates get suppressed because of foreign flows or RBI keeps its interest rate down, those infra projects can be now feasible, and that could change a lot of things in the economy. Similarly, consumption patterns could also change. As Subbu explained, the EMIs fall and people could afford within same EMI a larger house, a bigger car. So that also helps because of fall of interest rates. Yeah, so as I said, because of lot of flows, economy recovering, we had seen a sharp dip to kind of 15-16 times of P multiple for the index, Sensex index, and then it shot back to more than 30 times. Now, one anomaly over here is that this is based on FY21 current year earnings, and in current year Q1 was washout. So it is more of a 3/4 of earnings, and that is why optically it looks a little elevated. Even if I adjust for that, still it will be on the expensive side, but not at 33, 34 as what the chart is suggesting. So that we need to adjust that anomaly of no earnings in the Q1 which happened this year. So kindly, if you adjust to that, the index will still be expensive, but it will not be prohibitively expensive. So flows plus economic recovery is showing that kind of your P multiples. Now, what will change this P multiple is either market comes down or the earnings go up. Yeah, so from an earnings perspective, this table of consensus earning expectations also gives us a certain view that what is the market pricing in, right? Now, if you look at the background of light blue background, that is your Sensex, and these lines that are coming down is expectation of earnings by the sell side of BSE Sensex. So every year they start on a positive note and the earnings continue to fall down. This is happening for last 4 or 5 years, maybe more. If you look at FY21, which is the blue line, third line from the left, right, that has seen a sharp cut. So 21 saw a sharp cut, 20 also saw a sharp cut because of March, the lockdowns had started in March. So people have adjusted for COVID decline in FY21. It's also adjusted in FY22. Look at FY23, the adjustment is there, but still marginally. From a 21 base, which is closer to 1400 rupees earnings, now the consensus expects that the earnings will move to 24 to 2500 rupees. Some part of it is fair because there is a base effect which will play on. Even the real GDP for FY22 is expected to grow in double digits. So large part of that is fair. But again, there is a lot of uncertainties, few of which Subbu talked about, that there could be resurgence in COVID. There could be other things which I'll talk about in the risk slide. So we have to be careful about how we go from here on. From our perspective, we have been cautious. We have been carefully analyzing our companies, and then we are projecting our numbers. It could be very similar to what consensus is expecting, but on a different set of companies. So large part of this consensus change that you are seeing is driven by banks, but that would not be case in our portfolio. Over the last 1.5 to 2 years, a lot of questions have been asked about value style, quantum being focused on value, our key products are focused on value. We are known as value managers. So we have been analyzing things and how whether value makes a comeback or no. A lot of media, a lot of debates on that. So if you look at, I have just pasted a chart. This is a comparison between MSCI Global Value Index and MSCI Global Growth Index. So the orange dotted line that you see is the growth index, and the white line that you see is a value index. So from November onwards, post the vaccine announcement, you have clearly seen value started to do well. In India, it was a bit early also. When cyclical recovery started, the value started to do well, which was not the case over the last 2 years. So what happened in last 2 years, which has changed over last 3 months? So over the last 2 years, the economic growth, as alluded by Subbu in one of his slides, the growth fall in GDP growth was started much before COVID in India. In a falling growth environment, there were few companies who started to do well because they were gaining market share. They were good businesses and they gained market share. And there was a lot of liquidity coming in, and everybody was chasing those growing companies, making the valuations very, very prohibitive. Rest of the companies, because the growth difference was high, nobody was looking at those companies, and those were the companies which a value manager would look at, an expectation of a kind of catalyst playing out and the margin of safety getting covered, and you get your returns. That was not happening over the last 2 years because there was no cyclical recovery, and the catalyst that we were looking out for companies were not playing out. Over the last 3 months, the cyclical recovery is much broad-based. If you look at it, a lot of sectors like autos have started to do well. Financials have surprised on the positive side. Metals, utilities, all of these have started from a numbers and recovery perspective. It started to do well. In a broad-based economic recovery, what happens is that a lot of companies start to do well. And now the growth differential between a growth company and a value company compresses. And value is available cheap. So everybody would question, why would I buy a 40 PE company when the growth rate of a 15 PE company is similar? So the 15 PE company starts to improve in performance. And we believe that trend has started to play out. Yeah, so I'll just talk about our quantum long-term equity value product as well. How are we positioned in this environment, and what are we thinking, and how the portfolio looks right now? So from a portfolio positioning perspective, we clearly believe that there is an economic recovery that is happening, and a portfolio positioning is towards that, is geared towards that. So the monsoons have been good, and that has been for 2 years consecutively. And even this year's monsoon was good. This means reservoirs are full, and Rabi season, which is the winter cropping season, is expected to be good. And in our portfolio, we have some agri-facing stocks, rural economy, which benefit from rural economy, and we believe that those stocks will continue to do well. Those have done well in this rather bad environment. Those companies have done well over the last 6-7 months, and we believe for the next foreseeable time, maybe 6 months, 1 year, we believe those companies will continue to do well, will see good earnings growth. Now, last 2 years, what has changed from a portfolio perspective is that we were not able to buy high quality names because of prohibitive valuations. In March, when the markets fell because of COVID, we are able to add some of those names, some of good quality companies at reasonable valuations we would buy, and that has changed the structure of the portfolio. We have a higher weight in NBFC, consumer discretionary, and IT. IT being beneficiary of global digitization wave post the COVID. We also did a stress test on the portfolio, and portfolio companies look really strong from a balance sheet perspective. When March, April, when things were falling really badly, and there was lockdown, we tested whether companies' balance sheets are strong enough to take care of the cost when there is zero revenues for next 6 months. And almost all the companies passed their test. Few companies which did not have a strong parentage. So we are not, and when required, parents can infuse capital into those companies. So from a stress test perspective, the portfolio is very, very robust and the balance sheets are strong for the companies. We have close to 9.5% cash. And in case of a correction, because of some of the risks playing out, that cash will be used to add good names in the correction.
What Saurabh was saying was that what should the investors do? They should have a neutral way to equities. It's not necessary to book profits and get out of the equity market because it has gone up so much. And you need to diversify across styles. Beware that in small cap has done well, but small cap was always some challenges, and therefore be careful when it comes to small cap investing. The economic growth normalizing has been faster than anticipated. The low domestic interest rates driven by RBI can be a strong catalyst in sustaining this kind of growth. As we said, both the actions by RBI and the possible flow of money from foreigners could keep the yields in India low, and that could drive consumption, and therefore the economic growth could be better. That is a possibility as of now. We are not yet fully sure that will happen, but we are working on our models on the assumption that if this kind of money were to come, what would our buy and sell limits look like on every stock which we own? And therefore, we will reposition the portfolio once we are very clear that this kind of money would come and keep the interest rates low. Risk, as we shared, would be the COVID cases, resurgence in that, the elevated valuations, and any possible mishaps, from policy actions. The government, of course, has been taking a lot of steps towards reforming certain sectors. But in case something were to happen, like it happened in the past, like say demonetization or any other policy mishaps, that can impact the returns. So these are some of the points which the investors can keep in mind as they continue to remain invested in the equities.
So we have always said, as Subbu had said in the previous slide, that a mix of style is extremely important for the investors. Now we have seen over last 2 years, 18 and 19, value did not do well, and I have explained the reasons. These are a kind of setup of macros or setup of markets. Sometimes happens that the style is not favorable for a certain period of time. Similarly, you will see last 6 months, most of the growth managers have lagged the benchmark and the value managers, right? So how does an investor gets immune to these kind of style changes that happens in the market? The easy option is create a basket of product, which is not specific value, in the sense that you have a basket of value products plus a growth product. And if you want to size it, also some cap products. So we have just given a comparison of one of our products, Quantum Equity Fund of Funds, which is a basket or a mix of products into mid caps, large caps, and different styles. And QLTVF is our value product. If you combine the though, an ideal ratio would be 20% in the long-term value product and 80% in the FOF basket. You can see your returns are much more steady. Right? So to get that steady return, because you are investing for long-term 15, 20 years, and you don't want to be have a setback for if 2-3 years the style does not work, the best idea has to have a combination. So for 1 year perspective, you see a fund of funds gave you 6.7% return, but QLTF outperformed by 7% return. A mix would have given you 6.8%. But 3 years return, if you look at fund of funds gave you 4.16, QLTF gave you 3. So QLTF is a lower return product from a 3 year perspective. A combination would have given you 3.84. So if you are investing, which you should from an equity investment perspective, a combination of value, which should be your core investment, and build a basket of other styles around it. A typical mix should be 20% and 80%, 20% on value, 80% on the periphery, that should be a good basket to achieve your financial goals. So broadly, that covers up our presentation. Ghazal, you want to take over for question and answers?
Thank you, Saurabh. Thank you, for sharing your vision on what the future holds for equity markets. Hope you're ready to take some questions now because we have loads of them coming in. So I'll start with you, Saurabh. Is Quantum AMC buying large cap stocks at the Nifty PE of 35?
So clearly, I said that from an index perspective, index looks expensive. One reason is that anomaly of one quarter earnings missing, and that's why you are seeing a 35p on Nifty or 32 times on Sensex. Just for that, it will be lower, but it still be on the expensive side. The only point we would like to make here is that from a broader market perspective, you still see opportunities, and I highlighted a few sectors where we have portfolio positioned towards. We see that those companies are still fairly valued. We have not seen initiation of new kind of stock that came into the portfolio last 1-2 months. But within the invested portfolio, we see reasonably good opportunity upside over the next 2 years. So we believe that broader market still gives you opportunities. Yeah, index looks expensive.
Sure. Subbu, next question for you. Raghuram Rajan has recently commented that massive liquidity being pumped in by major economies is unsustainable and may result in sharp economic reactions. How do you think it would affect equity markets in India and investments broadly?
So, see, too much of liquidity has got its own problems. For instance, if you look at it can translate into inflation at the street level. It can translate into asset bubbles because all that money ultimately has to go into some assets. So it can drive equity prices up, or it can drive bond prices up. But the question is, are they sustainable? So there are enough historical reasons to suggest that in the long term, it's quite possible that the interest rates may move up for a variety of reasons, in which case, definitely all the financial assets will take a hit. If interest rates were to move up for some reason, you will find equities taking hit and bonds taking a hit, etc. But based on current facts, in the sense the response to the pandemic, immediate response seems to be that keep enough liquidity available so that businesses can sustain. So if that trend, it may continue for some time, and probably the kind of mishaps which Mr. Rajan is saying may not happen, but that risk always remains. And that is one of the reasons why at Quantum we have always been saying, and Chirag has been writing, is that always have some exposure to gold, which is moving away from an financial assets which is only backed by currency. Ensure you have 10 to 15% of your assets in gold. So my suggestion is, we don't know when this kind of liquidity will get squeezed out, but that risk remains. So therefore, ensure that you are adequately protected by being diversified across assets, and also ensuring that you have some amount of gold in your portfolio.
Thanks, Subbu. Coming back to you, Saurabh. Does value investing increase portfolio turnover compared to investing in high quality companies?
No, not really. If you look at from a quantum value product to quantum long-term value fund, if you look at that, our turnover ratios are pretty less. So churn ratios of 20%. That means when we hold the company, it's in the portfolio for average 5 years. So that's not true, and our churn ratios would be one of the lower in the industry. That's from the product perspective. From the style perspective, it's clearly not the case. Yes, valuations are important, but what happens is that if you've invested in a company at reasonable valuations, and because the intrinsic value of that company will change every year based upon earnings, you can have in the portfolio companies which can stay for long period of time, until and unless they really shoot up in valuations, and where you want to trim. Like ultimate is that you don't want to own over expensive companies, and you have to take that discipline and risk management. But I've not seen that value managers having higher turnovers than growth managers. I've seen it contrary rather.
Sure. Thanks, Saurabh. Subbu, what is your analysis of our capital markets if the dollar collapses?
See, if the dollar collapses, you will have implications across board on a variety of currencies. So I'm not a currency expert to tell as to what will happen to the rupee. I can only say if dollar is collapsing, other currencies will appreciate. So Indian currency will appreciate, and that will have its own implications both on the financial assets as well as on our export industry, right? So at this point, I cannot say what will happen to the currency, but all I can say is that if dollar was an asset where people were moving into, and if that currency is not stable, then people will look at alternatives, and one of the alternatives could definitely be again gold, uh, because there is no other major paper currency which can take the place of dollars. So therefore, people would evaluate gold very seriously. But frankly, I would suggest, Ghazal, you should organize another webinar where probably Chirag can give a much better view on, Chirag and Arvind can present on currencies and gold much better way.
Sure, Subbu. Another question for you, Subbu. Can you tell us if FPI inflows will be the main driver for equity markets, and why that would make Indian equity markets more attractive?
No, so if FPIs would definitely be one of the factors which would drive the markets. As I said, only money is not enough. You also need an economy which is growing, and you need an economy which is also delivering some earnings growth. So without earnings growth, eventually no flow can sustain. So having said that, uh, across the globe, when you look at India's growth market for a foreign investor, when they look at India and they see that it has the potential to grow much faster than their own home country, they seriously start to evaluate. Now, there are other risks that they don't know the country, the currency could go against them. All those risks are there. But just the growth rate differential could make India a lot more attractive for the equity investors compared to their home country perspective. But then if you look at the actual stock market performance, the other challenge has been because of this huge amount of liquidity, despite the slow growth in developed markets, even their equities have done very well. So the question people are asking is, for all the pain I took of going to a distant emerging market country, I didn't get the same kind of return which I got even in a developed market. And now you can always break and analyze it and say that stock market went up only because of a few stock. All those are reasons available. But the fact of the matter is, developed market also gave good returns. So I would say difference in growth could be a factor for foreigners to look at India. And from a bond investor's point of view, the difference in yields. If you are getting negative yield over there and you get a positive yield over here, despite the fact that you may lose some money in the currency, you will still be better off. So that could be one more factor why bond markets could also attract capital.
Sure. So, given the current state of the Indian economy, markets seem, still disconnected from the ground reality. So, would you say we are in a bubble? And if yes, when do you think this bubble will burst?
See, I would actually respect the market. I would not be. Uh, I don't buy to the argument that it is already a bubble and there is a disconnect. I think there is a connect, and one of the connecting factors would also be the cost of capital. If interest rates are so low, then you know that then your expectation on equities can also be low than the historical context. So therefore, the PE ratios will look higher. So today it doesn't cost much for a foreigner to borrow and invest in equities. Therefore, he or she is also willing to look more longer term. So earlier, if they were looking for, let's say, the trajectory over the next 1 year, today it doesn't, because it doesn't cost you much to hold. You are willing to look at it over a period of 2 to 3 years. So market is reflecting certain realities of the economy and is also a reflection of the cost of equity. So today cost of equity is cheap and therefore it is willing to pay a higher P/E ratio. But this is on a Sensex level. Now you have to always go beyond that and look at individual stocks, individual growth to decide what kind of portfolio you want to build. Because you may not necessarily buy only the Sensex stocks. So if Sensex is at 30, there are many other stocks outside the Sensex which are available at 20 times, 18 times. So you can still go ahead and invest in those. Uh, but the risk always remains. You don't know when things will change, at what point in time interest rates will change, and when will things deflate. As I said, did you expect COVID to come and the market to react in the first 3 months? No. So there could be any external factors which could drive the markets down.
Sure. Thank you, Subbu. Subbu, coming back to you, almost all managers are talking about the revival in consumption demand, possibly a spurt too, because there's pent-up demand. But don't you think that given the experience of 2020, there will be an increase in household savings as a buffer against similar crises in the future?
Yeah, that is a possibility. See, one is so that you may have higher savings, but your mental psychology would be not to consume. So that therefore that can also hurt the consumption. But what can also happen is the type of consumption you want to have. So today, let's say you were contemplating buying a two-wheeler, but today, given the fact that you don't want to travel in a crowded bus or a crowded train, you may go ahead and buy that motorcycle or a scooter which you had planned. A laptop which was probably one laptop in a household, typical household. Today, because many things are being done at home, you may require more than one laptop. So the patterns may change. Certain products will definitely have higher demand than others. So the consumption will definitely move up. But you are right. But psychologically, there will still be a lot of people who will not be willing to spend because A, they are still worried about the company in which they are working, or they are worried about the job which they are doing. And if they were to lose a job, or if their salaries were to be cut for some reason, then they should have the ability to, to either service the loan, or they should have the ability to save for their future. So all these factors will go into effect when people are deciding on their consumption patterns. But like it happens in many crises, the difference between the well-off and the not so well-off is always stark. The people who are already wealthy in such situations generally become even more wealthy, while the people who have lost their jobs, or where they will continue to suffer even more, and that will have an impact on their consumption patterns as well. That is one of the reasons why I think Saurabh was trying to indicate that we continue to be cautious in our investments. We still have some cash. We are not going gung ho that the consumption will pick up, because at the end of the day, if you look at the data, there is still a lot of job losses. If you look at CMI, it says around 6.5% is the unemployment rate. But then people who have moved out of the job market itself is quite large. So job losses, income losses will hurt to some extent, and that will show up somewhere going forward. So you've got to be a little cautious when it comes to investing in any particular company or stock.
Yeah. Subbu, what is the reason for modest index returns of 12% in spite of good economic growth both in India and internationally?
I don't know over what period this is being referred to, but economic growth in India was, as I said, pretty challenged from 2016 onwards. India was not growing at the same rate at which it grew earlier. So there was a slow growth, and definitely there was no earnings, right? If you remember in 2014, when the new government was formed, there was a lot of euphoria about India bringing in reforms, earnings growth to be fantastic. But Saurabh showed you a slide where actually the EPS growth from 2015 to 2020 was pretty much flat. It had not grown at all. Probably it is after this slide. Yeah, see over here, if you look at 2014, 15, 16, the end point is almost at the same level. So there was no earnings growth, but there was flows coming in, which made the markets go up, but eventually it corrected. So therefore you will find the returns ultimately reflecting what is happening on the earnings growth. So as I said, I don't know the time period for which the 12% was referred to, but this is what you can look at.
Sure. Subbu, the distinction between value and growth stocks is pretty clear in developed markets like the US. Would you say that is also true for emerging markets like India? And how is it that Qrtf can own HDFC Bank, which is also present in growth equity funds?
So again, as they say, value lies like beauty lies in the eye of the beholder. The same way, how do you value companies? It also depends on certain metrics. So I think there is a differentiation. The growth companies, they are perceived to grow at a faster pace. Therefore, they are generally more expensive. While value will also require earnings growth. Please remember, value does not mean that there is no earnings growth. There is earnings growth, but you are not willing to pay a high multiple for that. And that kind of differentiation you will find in India. Like I think Saurabh gave an example that in the last few years, even companies, if they show a slightly higher growth, their multiples expanded because the value companies were not showing any growth at all. So if you look at price to book, if you look at price to earnings metrics, you will find a difference between a growth stock and a value stock, and you will also find enough companies which are considered growth. But if you actually look at their earnings growth over the last few years, you will find that they have not grown much at all. But the market continue to believe that they will grow, and given the easy liquidity, those kind of companies, if the PE ratio was say 30 times in 2015, has now become 70 times. So these anomalies will always remain, and this difference between a growth and value will always remain. But as again Saurabh explained, the conditions today are such that when the economy is just about to recover, most of the value stocks will generally tend to do well, because you will ask this question: if X company is offering me 15% earnings growth and available at 15 times, why should I buy a Y company which is offering the same growth but available at 40 times earnings? So these kind of questions will come, and therefore some preference will be there for some time for the value style of investing.
Thanks, Subbu. Saurabh has joined us back. Saurabh, please go ahead and complete your answer on the attractive sectors.
Yeah, so as in one of my presentations, cyclical should do well. From a growth perspective, yes, pharma is a defensive name. Valuations have moved up, so growth style I think should not favor, and cyclicals as they catch up on growth, they should do well. Autos should do well. IT in that sense stands out, being more inclined towards growth, but they are seeing kind of good earning momentum because of this whole digitization post this COVID thing that has happened. And we believe that we have to be very careful on their earning projections, because earning upgrade can clearly move the stocks cheaper, right? So we have to be very careful how the earning momentum has been. So there have been upgrades on earnings for that sector. So one of that sector one has to look out. Besides that, cyclicals, we believe that should do well from here on for a certain period of time.
So next up, is the Qrtf fund deploying any hedging strategies to limit the downside risks?
No, so ours is a very kind of a stylish, if I can say, use the word boring. It's either cash or stocks. We don't use any derivatives, nothing. So our kind of, because our perception of uh, kind of risk is more permanent loss of capital, which is the key thing that we try to protect. And as I explained, when this whole COVID thing happened, we went back to our models and checked the balance sheet quality of companies. So management quality and business quality and the balance sheet quality are the utmost important. So we don't want to lose our capital permanently. There could be volatility based upon how the stocks move in the fund, but it's either cash if valuations are high and we're not able to get good ideas at reasonable price, cash will increase. Or else, if in market falls like March, we quickly deploy that money because a lot of stocks are available at great valuation. We'll move to equities. So besides that, there is no other strategy.
So, Saurabh, are you expecting a correction in the market anytime soon?
Look, so as Subbu highlighted in his part of his presentation that there are risks, and I also alluded to in my summary slide, that there are risks to the market. So market as of now is not factoring any COVID resurgence or a second wave or policy mishaps like DEMO, GST, badly implemented GST or a sudden lockdown, right? So markets is expecting a steady recovery, a perfect recovery. Any setback to that thesis will result in markets seeing a correction. One of the case points is what happened day before yesterday. A mutant virus was announced by UK, which spread 70% faster. Market was clearly not prepared for that kind of news, and you can see that how the equity markets across the globe fell. So clearly, market is not factoring in any expectation of any bad news, and any such event can result in a correction that could happen.
So, sir, would you say this is a good time to book some profits?
Look, so in a portfolio, when you are, our idea to book profits is generally you should be focusing on your financial goals, and we have explained this in our part 2 profits whenever we have done that you should attach your financial goals with your financial asset allocation. You've invested in equities for a long time. So there's no point that you try to time the market. It is very, very difficult, and even experienced investors have failed in timing the markets. Our view would be that you continue to allocate your money based upon style, create a basket, and look from a longer term perspective where you can get a steady state of return, and that covers for inflation and capital appreciation. So if you want to time the market, it will be a difficult thing to do.
Sure. Sir, what is your opinion on PSUs trading at attractive multi-year low valuations?
Look, so that basket has been there in our portfolio over last 2 years because of few reasons. One is, as we've highlighted, there was lack of growth catalyst in few of them. Secondly, government was kind of issuing their share of capital to ETFs at lower prices, so that the regular supply of equity shares also suppressed their valuations. But they continue to be really a good value play, and we have seen that play out over the last 2 months, and their dividend yields are very, very attractive. We believe they're still a good value play, and some of them are regulated return businesses, some of them are good cash generating businesses with steady dividend yield. And we believe as cyclical start to move up and macroeconomics start to improve, those utilities and PSUs should do well for the portfolio.
Thanks. Sir, what are your views on the agri sector, especially in light of the farmer protests?
Look, so we have, first of all, from agri perspective, we've told that at least the monsoons have been good, and that has been the silver lining over last 1 year actually. If you look at every quarter's GDP growth, agri has stand out because of good monsoons and demand and consumption. And in the initial stages of the COVID, the spread was more in urban areas, so agri was clearly less impacted, so that also helped. From a farm agri protest perspective, our view is kind of, we try to look into those 3 farm laws that the government have passed. We believe that there is some anxiety among farmers that the MSP would go away, and since Haryana and farmer account for 90% of the MSP, which is the minimum support price, those farmers are the most agitated. Rest of the country, the farmers are not as agitated. When we look in detail of those 3 laws, we are not sure what kind of problem it is trying to solve, because the key problem of Indian agriculture is one, a very, very small farm holding of the farmers, which so that they cannot use technology and they cannot afford higher technology because their farm unit is smaller, their land holdings are smaller. That is one problem. And the second problem that the Indian agriculture has, that it is skewed in terms of what needs to be produced in India for India and what is getting produced. So India is already surplus of wheat and rice, but our kind of 85-90% of minimum support price is targeted towards that. And we are the biggest importers of edible oil and other products, but there is no kind of focus to grow those products where the farmer remuneration could be better. So we are clearly not sure that how those problems get solved with these 3 laws. Farmer agitations could be politically driven or not, that the jury is still out. But we are not really sure that these farm laws solve the majority of the problem which Indian farm sector faces.
Thanks, sir. The next question, Qrtf used to be in the top 5 funds for several years, but for the last few years it has slipped to below 10. Why should I remain invested in the fund, and how can you explain its underperformance? Either of you can take this question, please.
Yeah, so maybe, Subhi, you want to take it?
Go ahead.
Yeah. So only point, I think in multiple slides, we have tried to explain that this is a style risk that you carry, and quantum long-term equity value fund is a value product. And globally, value styles have not done well over the last 3 years, and that suppresses our long-term returns also. Now, there were two things. One is the value style was not in favor. Good quality companies were expensive. I can partially explain what has changed this year, and which I tried to in one of the slides, that our portfolio positioning has improved. That is first. March fall gave us an opportunity to buy into good quality companies which have good businesses and were available at great valuations. So that is the second thing that has changed over last three, what was not happening over the last 2 years and has happened this year. And the third is definitely the cyclicity of macroeconomics that we were talking about, and that has started to play out, where value style starts to do well because cyclically macro economy improves, and cyclical sectors and suppressed sectors starts to do well, where we found value over last 2 years. So these are the two or three combinations that we believe from here on value could catch up. And we've always said that a combination of value and growth is the place that you should be, because there could be periods where underperformance can happen in a value style. Same thing happened in between 2006, 7, and 8 when markets was kind of on a tear, and everything was just running, and high risky companies were giving you the best returns. So that point in time, QLTF underperformed for good 3 years, and that has been the case between 2017 and 2019.
Can
So
I
from here
also
on,
add? Yeah, sorry.
yes, go ahead.
Yeah, sorry, sir. I thought you finished. You want to finish?
No, I'm done, Subbu. Go
Okay.
ahead.
So I will also add over here that 2019 was a difficult year, and we had done a complete webinar, I think, in April of this year to explain to all our investors under what conditions we will do well, under what conditions we will not do well. And if you look back in our history, right from 2006, it actually worked exactly the way we said. We said in markets where risk is not adequately priced, we will not do well. In markets where risk is adequately priced, we will do well. And we were able to prove that time and again. 2019 was a very difficult year and a very different year. We also had certain stocks which were duds, which did not do well. It met the valuation criteria, but there were no catalysts. One of the big exposure we had was to the PSU stocks. And PSU stocks, whether you look at it on a P basis, price to book, or even on a dividend yield, they are attractive. But 2019, with the government selling its stake, most of the PSU stocks declined very sharply, and that hurt our performance big time. So that is one of the reasons. Then we also shared that that we had Yes Bank in 2019 in our portfolio, which hurt our performance. We went wrong in our analysis over there. That did hurt. So there were a couple of reasons why 2019 was extraordinarily bad for us, and that dragged our performance. But we also said in April that we undertook a review of our process, and now we are a little more sanguine to the fact that we need to move fast when there are problems. And those kind of changes we bought in the portfolio. And last but not the least, when you look at the Sensex, not owning Reliance hurt our relative performance big time. Right? If you look at it from January 17 onwards, and you compare our performance versus the BSE Sensex, not owning Reliance would have probably hurt us by nearly 40% of our underperformance can be explained by the fact that we don't own Reliance. So that is our style. Like we don't like certain companies for certain reasons, and at certain points in time it can hurt. This year has been good, despite the fact that we did not own Reliance. Still the portfolio managed to perform reasonably well.
Thanks, Subbu. Thanks, Saurabh. Subbu, what is Quantum's view on inflation for FY 21-22?
I think our internal team still suggesting is around 5.5% kind of numbers. Although they do expect that the food inflation, which is a problem right now, will um, come down. But I think on a more longer term basis, that is the kind of number which they are looking at. Saurabh, that's correct, right? Around 5% is what we would look at.
Yes, Subbu. Yes.
Oh. Saurabh, with the most recent SEBI circular on multi-cap funds affect QLTF?
No, so it doesn't. Our categorization is not multi-cap. Our categorization is value. So it does not impact either quantum tax saving fund or quantum long-term equity value fund.
Sure. Subbu, what are your views on the flows from active funds to passive funds?
See, that is a trend which is happening across the globe. Um, but in India, we still think that there is a role for active funds because the benchmarks or the index in India is still not very stable, and it's also very poorly composed. And that's one of the reasons why we feel that in India there is a case for active management more than passive management. But it is a global trend because passive management is cheaper, the expense ratios are low. So there is a trend. So we can't fight the trend. But as we have said, in a developed markets versus India, in India there is still a larger role for active funds to do better.
Saurabh, in terms of equity investments and quantum's equity funds, can you elaborate on the ideal allocation between QEFOF, QLTEF, and QESG?
Yeah, so we've always said that, and there was a slide in the fag end of the presentation where we presented that your ideal strategy would be 20% to quantum long-term equity value product, a value product as core of your equity strategy, and build a periphery around that with the equity fund of funds, which is having a 4 to 5 good quality, well curated active funds that Chirag and his team builds for investors, and a layer of ESG product, which is like the new way of investing, and a lot of international funds are focusing on ESG investing, which is environmental, social, and governance, all three factors put together. So 20% in the quantum long-term equity value product, and 80%, so it could be 70% in FOF and 10% in ESG, and that could be your basket for your equity allocation.
Subbu, can you please throw some light on Atul's exit as fund manager? We have a lot of questions coming in from investors on that.
Yeah, sure. Atul exited from the fund a month back, and I think from December 1st onwards, we completed whatever statutorily we had to communicate in terms of, from what date the new fund manager would take over the funds. Atul was a great colleague. He's a great friend. He has been with us for a long time, more than close to 15 years. But he had other plans. So therefore we respected his judgment and his desire to do something else. After having worked with him for so long, we tried for some time whether we could do something for him to stay on. But because he had a very strong desire to do something else, we parted the ways, and that's when we announced, saying that Saurabh would step in now as the fund manager.
Thank you, Subbu.
Yeah.
Subbu, as a synopsis, what is your view on the year 2020 and its impact on investments and overall wealth creation?
Sorry, come again. What is the?
If you could just how has the year 2020 impacted investments and overall wealth creation? If you were to summarize that up.
For you mean to say for any investor?
Yes.
Yeah, so any investor, if you look at the sharp correction which we had in March, and then you take into account the fact that we are a growing economy. See, first of all, for an equity investor, you need to be an optimist. So standing in March, you have to be optimistic. Okay, this is a current problem, and this problem will get resolved. And if you have that attitude, then definitely you will make an investment in equities, and that should have panned out quite well for you this year. But how to plan where to invest would all be dependent on your financial planner and your your goals and risks and risk appetite which you have. That will help you decide where to invest. So I think by and large, people who have invested in equity in this year, they have done well. They can always reshuffle the portfolio towards one style or the other, but stay invested. If you don't require the money right now and your long-term goals are still to be met, I don't think you should just book for the sake of booking profits. And needless to say, you also had gold, which did very well. Equities have done very well. It is the liquid funds where the interest rates continue to be low, but that's a safety bucket. You can't really expect a lot of returns from the liquid fund.
Thanks, Subbu. Saurabh, A final question for you. In 2021, what prudent allocation strategy would you suggest for investors to build wealth in the near future, regardless of money movement?
Yeah, so I think definitely our thought process over here is pretty clear that you have to attach your allocation to your financial goals. It cannot be for a year. If your financial goals, if they are long term, you need capital initially for it. The time where you want to reach and how much time is left, that would be important. If it's more than 3 years, definitely an equity biased strategy would be important, is necessary. Equity and a combination of gold. If you have more than 3 years view, less than 3 years view, you could have into multi-asset product, liquid product, and if you have an understanding of debt, and that's extremely important because most people think that debt you cannot have losses, but that is not true. So less than 3 years, a multi-asset strategy or a liquid fund or a bond fund kind of strategy. But beyond 3 years, a good combination of equity and some portion of hedging via gold is a good asset allocation strategy.
Wonderful. Thank you, Saurabh. With that last question, we've come to the end of the Q&A. I will now request you both for your closing comments.
Yeah, Ghazal, just one thing I would always suggest that because there are questions on asset allocation, I think we should have another good webinar where, Chirag and Arvind, they all participate.
Sure, Subbu.
Because they do manage the quantum multi-asset fund, which is an asset allocation fund, and we can have a much more engaging talk with the investors.
Yes, Subbu. Noted.
Yeah, so closing comment, as I said, be invested if your financial goals are still far off. Always be cautious. It's not a one-way street. Today there is a lot of money being printed, and that money is coming into financial assets. But these are risks which can bring in definitely correction in the markets. We don't know when, so you have to be cautious. I think there was a question about Sensex valuation versus Sensex valuations. So also remember that while the Sensex is expensive because it has certain stocks which is expensive, outside the Sensex there are stocks which are still reasonable. So for instance, if you look at the portfolio characteristics of the quantum long-term value fund, you will find that the PE ratio of quantum long-term value fund is much lower than the Sensex. So from a valuation perspective, to own quantum long-term value fund makes sense because you are not buying it as expensive as the markets. So these are just some of my closing comments, and always have some investments in gold. I still remember a lot of investors when we were talking to them in 2015-16 were really upset that gold was flattish, not doing anything. But then suddenly you found how it benefited the entire portfolio. So please do invest in gold at all points in time.
Saurabh, your closing comments, please.
Sure. So before the closing comment, there was a question in the chat that how long I have been associated with Quantum. So I joined Quantum in 2011, and I have been part of the portfolio team since 2016, October 2016. So just that I'm here for a pretty long time, and I understand the process and how Quantum works. Just to clarify on that. On the closing remarks, yes, as Subbu said very clearly that. There will be volatile times, and you have to be optimist if you are an investor into equities. For that matter, in most part of investment, you have to be an optimist that this too shall pass, and that's the important phrase in your life when you are in equity investors. Volatility is not necessarily your enemy, it's your friend. We have seen that, and those volatilities help Quantum to pick stocks at worst times. When everybody is looking against equities, we look at equities and try to get good stocks in your portfolio. So our only view is that don't get swayed by near-term events, and put your allocation based upon your financial goals. Sit tight, and you'll see the returns coming your way. Thank you.
Thank you, sir. Thank you, Subbu. To our investors, thank you all for tuning in. We've tried to answer almost all questions. Some of them were repetitive, so we've asked them broadly. We hope the insights from this session will add value to your investment journey. Here's wishing a happy new year to you and your family from Team Quantum. And on that note, we will be wrapping up the session now. Good night.
Thank you. Thank you, everyone. Wish you a happy new year. and have a safe 2021.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.